Hey there and welcome. So, you've got that big insurance exam coming up? Well, you have landed in the perfect spot. Think of this as your personal high-yield study session. We're going to lock in the key concepts you absolutely, positively have to know.
Okay, so maybe grab a coffee, get your notes handy, because we are about to dive deep. We're going to break down all the fundamentals so you can walk into that exam feeling totally confident.
So, here's the game plan for today. We're starting with the very basics, then building on that with the core principles. Then we'll get into the details of perils, hazards, and loss, talk about risk, and wrap it all up with a quick review to make sure it all sticks in your brain.
All right, let's jump right in. The absolute foundation of insurance. At its core, it is all about one big, simple idea.
And that idea is transferring risk. An individual or a business pays a fee, we call that the premium, and in exchange, they get to hand off all that financial uncertainty of a potential loss to an insurance company. Simple as that. Seriously, everything we talk about today is going to come back to this one idea.
Okay, but for this whole transfer of risk thing to work as a real business, it's got to follow some rules. You can't just do it willy-nilly. So let's look at the principles that make this whole thing possible. First up, the law of large numbers. This is kind of like the statistical magic that makes insurance work. See, an insurance company has no idea if you, specifically, are going to get into an accident. But they can get shockingly accurate at predicting how many people out of a huge group will have an accident, and that's how they figure out what to charge for premiums.
Yeah, check this out. It's pretty straightforward, right? The bigger the group of similar people or things you're insuring, what the industry calls homogeneous loss exposures, the easier it is for the insurer to predict what's going to happen. It's all a numbers game, really. It's all about scale.
Okay, this next one is super important for your exam, the principle of indemnity. The key takeaway here is that insurance is meant to make you whole again, not to make you rich. It's all about restoring you to the same financial spot you were in right before the loss happened. You're not supposed to come out ahead. That's a big no-no. All right, now let's talk about a big problem that insurance companies are always trying to solve: adverse selection. Basically, it's the fact that the people who are the highest risk, the ones who probably need insurance the most, are the ones who are going to be banging down the door to buy it. So to stay in business, companies have to be really smart about their underwriting to make sure they don't just end up with a pool of only super high-risk people. Okay, let's shift gears and break down what actually goes into a claim. I can pretty much guarantee you will see these three words on your test: peril, hazard, and loss. So you've got to know the difference cold. So first up, peril. A peril is simply the cause of the loss. It's the what happened. For health insurance, a peril could be an accident or getting sick. For life insurance, well, the peril is death. It's the direct event that kicks off the whole thing. And that peril leads to a loss. The loss is the result of that peril. It's the actual financial hit you take. So, for example, the hospital bills from an injury, that's a direct loss. But don't forget, there's also the money you can't earn because you're out of work. That's what we'd call an indirect loss.
And number 3 is hazard. Now listen up, because this is a really important difference. A hazard is not the cause of the loss itself. Instead, it's a condition that just makes a loss more likely to happen. Think about it. Icy roads don't cause a car crash, but they sure are a hazard that increases the chance of the peril, the crash, happening.
And just to keep you on your toes, there are actually 3 types of hazards. And yep, you guessed it, you're going to need to know all 3 for the exam. Let's break them down.
Okay, seriously lean in for this one. This is a classic exam question where people get tripped up. Moral versus morale hazard. A moral hazard, think M for malicious, is all about dishonesty. Somebody lying on an application or even intentionally causing a loss. But a morale hazard is just about being careless or indifferent. It's that, I'm insured, so who cares? So one is about dishonesty, the other is just about not caring.
All right, so we've got the pieces of a claim down. Now let's zoom out a bit and talk about the whole concept of risk itself.
And here's another huge distinction you've got to know. Insurance only covers something called pure risk. That's where there's only a chance of loss, no chance for gain, like a car crash or your house catching on fire. The flip side is speculative risk. Think gambling or investing in stocks. There's a chance for gain, but also a chance for loss. You can't get insurance for your bad stock picks, and this is exactly why.
So when we're all faced with any kind of risk, there are really only 4 things we can do about it. You can try to avoid it altogether, like just don't buy that motorcycle. You can reduce it, okay, you bought the motorcycle, but you wear a helmet. You can retain it, which basically means you self-insure and hope for the best. Or number 4, you can transfer it. And guess what that is? That's insurance. It's the formal way to transfer your risk over to someone else.
Okay, we have covered a ton of ground. Now it's time for a lightning round review to really make sure these concepts are burned into your memory. You ready for this? Let's do it.
Here's a little nugget of wisdom you might see on the test. Remember this phrase: every accident is an occurrence, but not every occurrence is an accident. What's that mean? Well, an accident is sudden and unforeseen. An occurrence can be an accident, or it can be something that happens over a long period of time, like a slow pipe leak causing damage. That distinction can be a real game changer on a tricky question.
All right, pop quiz. We literally just talked about this. What is adverse selection? Come on, you know this. Think about who's first in line to buy insurance.
Yep, you got it. It's that tendency for people with higher than average risk to be the ones seeking out insurance the most. And that's the big challenge that underwriting is designed to solve. And now for the final boss question. This one kind of brings everything we've talked about together. What actually makes a risk insurable? What are the magic ingredients that let an insurance company even consider taking on a risk?
This right here, this is the checklist. This is what makes the entire insurance world go round. The loss has to be due to chance. You can't plan it. It has to be definite and measurable. You can put a dollar amount on it. It's got to be predictable, which takes us all the way back to the law of large numbers. And this is a big one. It can't be catastrophic. It can't be so massive that it wipes out the insurance company. If you can lock these elements down, you've really truly understood the foundation of how insurance works. I think you're ready. Go out there and crush that exam. Good luck.